Hi, today we are going to see about Introduction to Accounting. In this Introduction to Accounting, we are going to discuss about introduction, evolution, meaning, definition, objects and accounting cycle. These things we are going to discuss in this class. Before we are going to see about Introduction to Accounting, we should see some important terms, that is Porter stage or Porter system. What is Porter stage or Porter system? Here Porter system means goods exchanged for another goods. That is, one commodity is exchanged for another commodity. Is called Porter system or Porter stage. For example, apple is exchanged for rice. That is the Porter system. That is, one goods transferred for another goods. That is called Porter stage or Porter system. The Porter system has lot of drawbacks, lot of difficulties and a lot of disadvantages. To overcome these drawbacks, these difficulties and these disadvantages, another stage was emerged, that is called money value stage. What is money value stage? Money value stage is a stage or it is a system in which money is a medium of exchange. That is, money acted as an exchange media of transferring goods and services. That is the money value stage. Here, in the money value stage, fixing value for every goods, every commodities. That is the important in the money value stage. It led to transferring of activities which involve money or money's worth. Business organizations are of three types: sole trader, firm and company. Sole trader, it is a business organization which is run by single person. Firm, it is also one of the business organization which is run by more than 2 persons, maximum of 50 persons. Like that, company is also another type of business organization which run by or which carries larger number of persons. These business organizations are considered as a separate entities. What do you mean by separate entities? Separate entity means the business units or the business enterprise which is separated from its owner, its proprietor. That is, these business organizations carry on activities which involve money or money's worth. The activities which are involving is larger in number. Every business unit has to need to record all these activities, all these transactions for the purpose of taking the important decisions such as viable or not, whether reliable or not, whether it is profitable or not, whether these activities are to be continued or not to be continued. For taking these decisions, every business undertaking need of accounting. The accounting is needed not only by proprietor, that is owner or management, but also it is needed by other parties, that is government, investors, creditors, customers, researchers, etc. Next, we have to discuss about the evolution or origin of accounting. The evolution of accounting is associated with the civilization. Now, we are going to see the development of accounting stage by stage. The seeds of accounting were first sown in Egypt and Babylonia around 4000 BC, before Christ. They recorded transaction of payment of wages and taxes. That is the first development in the accounting. Next, in Greece, the accounting was used to maintain the records of revenues received in treasury. These records consisted of opening balance, total receipt, total expenditure, and closing balance. It witnessed the another development in accounting. In India, the accounting concept was traced from 23 centuries ago during the period of Chandragupta Maurya. His minister Kaudilya wrote a book on Arthashastra. In this book, Arthashastra, we found the way of maintaining the accounting records. That is the first concept traced in India. During the period of Chandragupta Maurya, his minister Kaudilya wrote a book on Arthashastra. In this Arthashastra, we found the way of maintaining accounting records. Next, in 12th century, the accounting was developed by stewards who managed the property of the wealthy people or rich people. They rendered accounts periodically to the owner of the property. This stewardship accounting is said to be the root of accounting records of debit and credit. That is, this stewardship accounting is said to be the root of accounting record of debit and credit. But in 1494, the Italian eminent named Luca Pacioli developed the double entry bookkeeping system. The double entry bookkeeping system was developed by Luca Pacioli in 1494. It is considered as proper and scientific method of bookkeeping system. To bring comparability and uniformity in the financial statement, generally accepted accounting principles were developed, which was followed uniformly throughout the country. To make them meaningful and comparable, the International Accounting Standard Committee was established in 29 June 1973. That is the development or origin of accounting in the world. Now we have to know the meaning and the definition of accounting. Accounting means the systematic process of identifying, measuring, recording, classifying, summarizing, interpreting and communicating the financial information or the financial events. It is called accounting. Here it is a systematic process, that is systematic process of identifying the financial information, measuring the financial information, recording the financial information, classifying the financial information, summarizing the financial information, interpreting the financial information and communicating the financial information. It is called accounting. Here the first two steps, identifying and measuring of financial information, which are related with business transactions. Recording of the financial information related to making journal. Classifying the financial information is of, after making journal, it should be classified into ledger, posted into ledger. After ledger is over, summarizing the financial events or the summarizing the financial information, that is your ledger balances should be prepared in a form of trial balance. That is summarizing the financial information. After summarizing the financial information, interpreting the financial information. The interpreting, which was facilitated by preparing trading account, profit and loss account and balance sheet. That is facilitated interpretation. That means interpreting the financial informations. Such interpretation which gives the results. That results should be communicated the financial information to the owner or any person who is needed the accounting. That is accounting. Again, I am going to explain the meaning of accounting. Accounting is the process of identifying, measuring, recording, classifying, summarizing, interpreting and communicating the financial information or financial events. That is called accounting. Next, we have to see the important definitions of accounting. We have to see the important definition given by American Accounting Association. The American Accounting Association has defined accounting as the process of identifying, measuring and communicating economic information, that is financial information, to permit the informed judgments and decisions by users of the information. That is the definition given by American Accounting Association. It is a accepted definition. Now we have to discuss about the objects of accounting. We are going to see the important object of accounting. The first object of accounting is to keep systematic record of financial information or financial events. We are maintaining a separate record regarding sales, purchases, income, expenses, assets and liabilities. It will be useful for in future evidence or future purpose. Next object of accounting is to ascertain profit or loss earned by the business undertaking or business unit. In order to ascertain either our business undertaking is making a profit or loss, that should be ascertained by means of keeping proper accounting system. Then another object to ascertain the financial position of our business unit or our business undertaking. The financial position means to ascertain the state of affairs, that is how much assets and how much liabilities. We see the balance sheet, that is the financial position. It is possible only by means of maintaining or keeping a proper accounting system. Next object, to provide information to the interested persons, the interested parties. Here the necessary information is to be provided by the accounting to the owner, to the management, to the government, to the investor, to the creditors, like that. These are all interested persons. They are in need of information. Such information is provided by accounting system or proper accounting. Next object is to prevent and detect frauds and mistakes. Here the next object of an accounting is to prevent or to protect the frauds and errors or mistakes. That is possible in the proper accounting system. Next object, to know the solvency as well as liquidity position of your business concern or your business undertaking. The solvency position means the net worth, the net assets available to the owner or the proprietor. Like that, solvency is a net worth. The liquidity means the immediately conversion of cash. It is ascertained by the creditors or the suppliers. To know these two things, that is solvency position of our undertaking as well as liquidity position of our undertaking, the accounting system is very useful. Next we have to see the accounting cycle. What is accounting cycle? That means some of the activities which are repeated again and again in the year by year. That is called accounting cycle. That is rotating the events or the rotating the activities year by year is called accounting cycle. That is sequence of events or activities are repeated year by year. It is called accounting cycle. The accounting cycle starts with transactions, that is business transactions. It started with the business transactions. These are all financial information. This transaction is going to make a journal, that is journalizing. Journal means journalizing the business transactions. So all the business transactions should be recorded in journal, that is journalizing the transactions. After journalizing the business transaction, we have to prepare ledger. Here ledger means the posting of journal into ledger. The transferring of journal into ledger is called posting. Here after posting is over, we have to find the balancing. So in the ledger we are having posting as well as balancing. That is balancing of each account. Every account which shows either debit balance or credit balance. That is the ledger. After preparation of ledger, that is balancing the ledger, we prepare a trial balance. That is trial balance. Trial balance is the summary of various ledger balances. It is a statement of the balances as appeared in your ledger. It is matched with debit as well as credit. Both debit balances agreed with credit balances. That is the trial balance. After preparing the trial balance, we prepare, that is, trading account. Trading account, it is related with the trade expenses and trade income. That is opening stock, purchases, other direct expenses like that, closing stock and sales. These are all items appearing in the trading account. It gives either gross profit or gross loss. After preparing your trading account, we move to profit and loss account. Profit and loss account, it is a account of all incomes and all expenses. That is, income and expenses should be prepared or posted in the profit and loss account. It gives the net profit or net loss. Then after preparing the profit and loss account, we have to prepare the balance sheet. Balance sheet, it is the financial statement which is consisted of assets and liabilities. That is, assets equal to liabilities. That is the balance sheet. That is financial statement or statement of affairs. Then the balance sheet is prepared at the end of the accounting period. That amount appearing in the assets and liabilities then transferred to as opening entry. Here it is prepared at the end of the accounting period, that is of closing journal, closing entries. This closing entry is to be transferred to opening entry of the next year. That is to make a journal. Again, the coming year there may be of transaction, there is of opening entry, make a journal, journal to ledger, ledger to trial balance, trial balance to trading account, trading account to profit and loss account, then profit and loss account to balance sheet. The sequence of activities are occurring year by year. That is called accounting cycle. Now we have to see the important functions of accounting. The first functions of accounting is measurement. Measurement means we are having a systematic record of financial information. That is, we are having set of books with regard to sales, purchases. From that we prepare trading account, profit and loss account, balance sheet. So the accounting is a tool for measuring the financial statement as well as income statement. That is the main function of the accounting system or accounting record. The next function is forecasting. Forecasting means to estimate the future, to predict the future activities, to estimate the future income as well as future financial position. How it is possible? By setting standard, budget, cash flow, the ratio, other tool of financial items will help the future activities, estimating the future activities of income as well as financial statement. Next, comparison. Comparison means the comparing our activities. The comparing our activities is of two types. One is intra-comparison, another one is inter-comparison. What is intra-comparison and what is inter-comparison? Here comparison is of two types. One is intra-comparison and inter-comparison. Intra means within the organization, within our business unit, we have to compare our activities. For example, sales of the previous year and sales of the current year. Like that, income of the previous year and income of the current year. The financial position of the previous year and the financial position of the current year. That is called intra-comparison. What is inter-comparison? Inter means between the organization. Our business unit compared with other business unit. That is, here X Limited alone compared. Here X Limited compared with Y Limited. That is the inter-comparison. The activities of the X Limited, that is the income of the X Limited compared with the income of the Y Limited. The sales of the X Limited compared with the sales of the Y Limited. That is called inter-comparison. So the comparison is to be possible. We are having a proper accounting. That is the another function of the accounting system or accounting record. Then decision making. Decision making means to take a important decision such as, that is, controlling the elements, controlling the cost, improve the efficiency in operation. All these managerial decisions, we should need the information, that is financial events. That is the another function of the accounting. These are all functions of accounting. Next class we go to see the importance of accounting, branches of accounting, phases of accounting, then role of an accountant. All these things we'll discuss in next class. See you.